Hey friends, Lucian here with the Bullish Bears team. This video is going to be on swing trading and what it is. So if you're new to the concept of swing trading, it's different from, let's say, day trading. So day trading, you're holding stocks for a few seconds up to a few minutes. Whereas day traders, they hold stocks or options, right? So you can trade both stocks or options between a few days up to a few months. So anything, where, you're holding a stock overnight, that technically makes you a swing trader. So if you're not selling a stock within the same day, that makes you a day trader. If you hold it past that day, then technically you become a swing trader. So it's anywhere from, a couple days to a few days. That could be a short-term swing trader up to a few weeks or a few months. Now, swing traders, they trade penny stocks as well as large cap stocks, like well-known companies such as Apple, Facebook, Netflix, Google, Microsoft. So while they're both popular to trade, swing trading is safest with larger cap stocks. Again, there's a time and place for swing trading penny stocks. You have to do more of your fundamental research and also making sure that you get a good entry before you enter into a swing trade on penny stocks. So you got to get that, buy near those support levels, not off of those major high wave candles or larger candlestick patterns. So again, too, you can trade with swing trading both stocks and options. So if you don't have a lot of capital in your account, lots of money, the good news is you can trade, stocks like Facebook, Apple, Netflix, Google with trading options, and you don't have to have lots of money to do it. Here's an example of what an options contract looks like with Apple. So you'll see on that order right there, you could buy a call option, about 11 days out. So this is 11-day expiration. So it's less than 2 weeks out, kind of a shorter term expiration. And you could buy a naked call for $315, and that controls 100 shares of Apple. So again, if you need help on options and how they work, make sure you take our options courses. But this is just an example to show you in swing trading, you can trade larger cap stocks and not have to have a lot of money. So when you're swing trading, just like any type of trading style, you have to know your entries and exits, right? You want to map out your trade anytime you enter in and exit before you enter the trade. So before you enter into any trade, have your entry and exit strategies done ahead of time. Don't guess, right? You want to know those proper support and resistance levels. So you want to enter in on small candles near support levels, and then you want to look to exit trades at reversal candles near resistance levels, and also at the break of trend lines. So here's an example of a chart on Apple. You can see I'm connecting those peaks and those valleys, which create those trend lines. And you'll see some examples of buy and sell areas. So you want to buy near support at those support levels, ideally smaller candlesticks off of support levels. And then you look to sell near those resistance levels or peak levels. So you think of with support and resistance, you think of support as floor levels, right? You want to buy low near the floor, and then you sell high near the ceiling. So that's where you can see in that channel that's being formed, those peaks, when you connect them, they hit like a wall, and those are resistance levels. So you want to find those channels, draw your upper and lower trend lines, and then find up channels and down channels. Again, this you can do them much easier with larger cap stocks. Penny stocks, they're a lot more volatile, so you'll see a lot more pumping and dumping. Again, you can trade them, you can swing trade penny stocks. You just gotta, again, the patterns are not going to necessarily be as reliable with penny stocks as they will be with larger cap stocks. So like with any type of trading style, you have to look at multiple different time frames, right? You want to look and find the trends overall, and then you kind of zoom in for your entries. So with swing trading time frames, you want to look at daily and weekly charts for the overall trend. That's, if you're doing kind of intermediate, a few days to a few weeks out. You want to look at monthly charts if you're doing longer term, if you're going to be in a trade for up to a few months. And then you want to kind of drill down into the hourly charts for the short term trend overall, and then look at your, 5 minute setup for a good entry, and then look at your 1 minute for entering into the trade. So you kind of want to zoom out and then zoom back in for your entries. So here's an example of a weekly and monthly chart on Apple. So you'll see, you kind of draw those, again, those trend lines. You can see in a weekly chart, you look at the trend line, you'll see price is kind of, bouncing off that lower trend line, and it looks like it's continuing up. But then you see, like on the monthly chart below, price is kind of far away from that lower trend line. So it doesn't mean, it won't keep continuing up, but just be aware, like when price, the more it goes away from those trend lines, a lot of times it'll come back and retest them. Doesn't mean it's going to happen right away, but that's why, when you look to get in, that's where you zoom out and then zoom back in and look to get your good entries. So again, you can see that lower trend line many a times, that's a monthly trend line, right? So that could keep going up for several months, right? Or it can come down as well. But that's why it's important to know those trend line areas, and you want to buy near those trend lines. So you have to determine how long you're going to be in that trade. So if you're going to be trading a weekly chart, the setup's pretty decent right now. It's bouncing off support. If you're going to be looking, longer term on the monthly, you just realize that, the trend line could also come in and come closer near that $113 area as well. But again, buy at support levels, and then you look to sell at resistance levels. So on this chart of Apple, we zoom in a little bit closer and we look at the hourly chart. So you'll see there was that nice couple little small candlesticks right off the hourly, and then you'll see the breakout, right? So, when you're doing those, shorter term swing trades like that, you like to see that set up there, those smaller candlesticks off of support. And then you'll see right, on that 5 minute at open, you'll see the thing just broke out at open. So you'll see that 5 minute chart breakout correlated with the hourly breakout. And so that's why it's important to look at multiple time frames. So you look at, kind of that trend overall, the intermediary trend on the hourly, and then you'll see the breakout happening on that 5 minute chart. So you hear us talking about candlestick patterns over and over in our community because they are the most important indicator to use when you're trading. They form the basis of bigger overall patterns, which form important trend lines, as well as short-term patterns, and those show you the reversals and entry areas. So candlesticks are the immediate price action. They're your best, most helpful indicator overall because all the other indicators are lagging. Now, some indicators are very helpful to use. They're used as a guide, such as moving average lines. But if you want immediate, your best indicator for immediate price action overall, it is candlestick patterns. So you'll see this chart right here. You'll take those candlesticks, all those separate candlesticks, and then you put them together to create those trend lines, and you'll see they form those bigger patterns overall. And you'll see that's with GLD here, it's basically a bigger kind of flag pattern. So price moves up and then it has that consolidation back for several months. And then you can draw that trend line up again, and you can see price might be moving up to form or create a third peak there, which will either hit resistance and fall back down, or it'll potentially break out. So that's why it's important to learn, these candlestick patterns, because then those trend lines are very important. So you can see right now, price is kind of forming, it's kind of going up again, kind of in a shorter term uptrend. So this is where you can do swing trading on a shorter term time frame at, a few weeks out to a month or so, and you'll see if price, watch and see if it'll continue up and go up near that $180 resistance level. So even though candlesticks are the most important trading indicator, moving average lines can be very helpful when you're doing swing trading because they show popular support and resistance levels. So again, you don't want to clog your charts and give them too much weight, but you'll see many of times price action does important reversals or pay attention to reversals near those moving average lines because those moving average lines show very popular support and resistance levels. So a couple or a few of the most popular moving average lines, if you're looking at simple moving average lines, the 50, 100, and 200 simple moving average lines, or SMAs, are very popular. And then you have for exponential moving average lines, you have, or otherwise known as EMAs, you have the 9 and the 20 EMA together, or you can use the 13 EMA. So if you use the 13 exponential moving average, you don't really need to use the 9 and the 20. So exponential moving average lines are more of the shorter time frames. The simple moving average lines are more of the longer time frames. So again, those are very popular, lines to have on your charts because price action will do, reversals at those areas many of times. So you want to use them as a guide. Remember, they are lagging indicators, so they are not foolproof. So you use them as a guide. Don't give them too much weight. So here's an example on my chart here of these moving average lines. You'll see that circle. I have the 50, the 200, and the 100 simple moving average lines. And then I have the 9 and the 20 EMAs. And you'll see just kind of as price, going back to that previous chart, you'll see price kind of fell below that black line, which was the 200 SMA, formed a reversal. Now it's moving up, and you can see those moving average lines are resistance. That 100 simple moving average line is important resistance level, right below that $180. So if price can continue up and then break and hold above that, price may continue and it might break out, right? So again, those moving average lines show very, very important support and resistance levels. You'll hear the term in trading, the trend, or the phrase, the trend is your friend. And it's very true. You want to, obviously, with swing trading, you'd like to catch a good trend, especially if you're going to be in that trade for several days, several weeks, up to several months, depending on what chart time frame or how long you're going out. So when you're doing trend trading and finding the trend, you want to find a trend up or down to develop. And then you want to look to connect at least 2 to 3 peaks and valleys, which create what they call megaphone or wedge patterns. And then you want to look for entries long or short near angular support and resistance levels. And then you exit at resistance or break of trend lines. So you obviously ideally want to risk off of those smaller candlesticks near support and resistance levels. Here's an example of those falling wedge, rising wedge, megaphone patterns on the SPY. You'll see those channels, again, using or, following larger cap stocks or, major indices like the SPY. They create those more reliable channels where it's a little bit more difficult to find them on penny stocks, but using, trading like Apple or the SPY, you can find those channels much more clearly. And you can see those falling channels, price breaks out, rises up, hits, resistance, creates down channels. So there's lots of up and down channels. So you ideally want to find those peaks and valleys, create those channels, which do those up and down trends, also known as those rising wedge, falling wedge patterns. So swing trading is a very vast concept. Obviously, there's so many different ways to do it. Again, a few days up to a few weeks or a few months. You can trade stocks, you could trade options. And there are several different ways to trade options. You can do, short-term options, at the money options. You can go longer term. You can do spreads. So again, lots of different strategies, and our trading community is a great place to learn how to implement these strategies and to learn how to swing trade. So we teach swing trading live each day in our trade room. So you can come into our trade room, ask questions, interact with other members, and then practice implementing what we teach you. That's why you'll hear us talk about practicing in a virtual account all the time. Very important. Great way to practice trading without using real money. So you got to start somewhere first, practice in a virtual account, then slowly scale your way up with real money. And same thing with our trade alerts. We have real-time options alerts that we call out. So if you're new, come in, take our alerts in a virtual account first, practice trading them in the virtual account until you get comfortable, then slowly scale your way up with buying real-time options alerts in your real-time account. So don't trade them with real money right at first, practice in your virtual account, then slowly scale your way up. So hopefully this video on swing trading helped you, and we'll see you in our community. Enjoy.